In this example, we're going to look at preparing the closing entries for a company that had a net income at the end of the year. So for closing entries, we only do them one time a year. We do them at the company's fiscal year end. We only close temporary accounts, and the temporary accounts are our revenues, our expenses, and our drawing. Again, think of that acronym RED. Our capital account is a permanent account. It does not get closed at the end of the fiscal year. However, it is going to get adjusted through this closing process. Basically, the closing entries are going to journalize the items that you see on your statement of owner's equity that change the value of our owner's capital from the beginning of the year until the end of the year. So before you get started, great thing to do is to determine whether or not the company has a net income or a net loss. So looking at the information here, we know our revenues were at $1,161,000. And if we add together our expenses total $823,350. So our expenses are less than our revenues, which means the company had a net income for the period. So we're going to close our temporary accounts. We do that first by putting in our date, and our date is always as of the last day of the year. Our revenue account, fees earned. Remember, our accounts that are balances that are shown here represent the account's normal balance, and the normal balance is whatever side increases the account. So for our drawing and our expense accounts, they increase with debits. So that means all of those balances that you see here for our expenses and our drawing are representing debit balances in our ledger. Our fees earned and our capital account both increase with credits, so those balances are representing credit balances in our general ledger. In order to close an account, we do the exact opposite to that account. So our revenue accounts, our fees earned account in this case, had a credit balance of $1,161,000, so we are going to debit the account for that amount. Remember, opposites subtract. So if there's a credit balance and this is a debit transaction, we're going to subtract the two. It's going to leave a 0 as a balance in that account. All of my expenses have debit balances, so that means we're going to credit each one of those accounts. So our rent expense comes next. You do not have to list your expenses in any particular order when you're doing your journal entries. That's only for your financial statements. So before we move on here, that tells us that we have fees earned is now closed. All of our expense accounts are now closed. If we think back to Chapter 2 and our very important rules regarding journal entries, let's go through them. Number 1, at least 2 accounts have to be involved. We have done that. Any account that's being debited has to be listed first, followed by any account that is being credited, which we've done, and our debits and credits must equal. So we know that on the debit side, we have $1,161,000. On the credit side, if we add all of our credits together, we only have $823,350. So our debits and credits don't equal. We are not done then with this journal entry. So revenues minus expenses gets us net income. Our net income on our income statement is carried down to our statement of owner's equity, and net income on our statement of owner's equity is added to that owner's capital value. So we're going to do the same thing. So our owner's capital, Carrie Buckner capital, is going to increase not by that $3.4 million. That's what her balance is now. We're not touching that value. All we're going to do is adjust that value through this process. What we're going to increase her capital balance by is the net income, the difference between the fees earned of $1,161,000 and the total expenses of $823,350. So our net income for the year was $337,650. We need a second journal entry, and that is to record the closing of the drawing account. Again, think about your statement of owner's equity. The withdrawals that the owner has done during the period of time reduces the value of our owner. So our capital account increases with a credit, so that means it decreases with a debit. And again, we're decreasing it by the withdrawal value. We're not doing anything with that $3.4 million. And we need to close her drawing account. The drawing account, just like your expense accounts, normally have a debit balance. So if we want to close the drawing account, we need to credit it.